Hi there, welcome to Safe Option Strategies and welcome to our presentation on how collar trading can save and grow your portfolio. My name is Jeffrey Dunyan. I am the owner and founder of Safe Option Strategies. Been teaching people how to do this for a little over 20 years total, but for a little over 15 years with Safe Option Strategies. And what I want to do is just take a few minutes here and talk to you about one of the primary strategies that we employ here at Safe Option Strategies. I got to tell you, everybody knows what to do when markets and stocks are going up, but not very many people know what to do when the markets are falling or when an individual stock that you own is falling. When things are going up, everyone becomes an expert. It is easy. I mean, literally, it is easy to trade when you've got a 9-month, 10-month bullish recovery following one of the most brutal sell-offs that we've ever seen in the stock market in such a short period of time. But what do you do when this is happening? Do you just sell and bail out? Do you hope that you got out right here? Or were you unlucky enough to not get out until right here? And if you lost all this money from here to here, you got to get all the way back up here before you're even back to break even. And then do you get spooked when you're dropping right here and get out again and not get back in until you're up here? There's a lot of people that know how to make money when the stocks are going up. When stocks are going down, it can become stressful, it can become challenging, and it can become absolutely heartbreaking to see your hard work get lost. When this pandemic hit at the beginning of last year, there were people who had their entire pension lose 35 to 40%, almost in the blink of an eye. I mean, literally, it seemed like it was overnight in some ways. I'm going to show you one of the things that we teach here at Safe Option Strategies that could literally have saved you all the heartache, all the stress of what happened during this pandemic. And I'm going to show you a way to trade close to risk-free in many cases and still make some phenomenal profit. For those of you that may not know, the collar trade is a trade that we use a lot at Safe Option Strategies. And it doesn't matter if you're brand new to trading. It doesn't matter if you have never traded a stock or an option before in your life. We can teach you how to do all of that. And as we teach you how the stock market works, as we teach you how to do fundamental and technical analysis on companies and teach you how options work, one of the things that we're going to teach you is the collar trade. And I'm going to explain it really quickly here and then show you how effective this trade can be and how profitable it can be. And more important than that, how much peace of mind it can give you in turbulent times. Because let's be honest, we are in some very turbulent times. Everything that happens politically every day has an impact on the stock market. Things going on in other parts of the world that used to not affect the stock market have a major impact on the stock market. Companies are reporting phenomenal earnings, blowing out the numbers that they're expected to reach, and the stock is selling off 25% over the next week because one or two analysts said they thought that company should have done better. I mean, you want an example of that? Go look at the chart for the last few weeks on companies like Amazon and Roku, Nvidia and Netflix. Go look at some of these big juggernaut tech stocks that have just led the way in this amazing market that we've had and this amazing recovery that we've had post-pandemic. And look at how they've been beat up over the last few weeks. And in almost every case, these are companies that have reported some really amazing numbers in their earnings reports. And this is just the world we live in right now. They're selling off and it becomes very, very difficult to trade any of these companies without this strategy. Here's how a collar trade works. Let's say you buy a stock, and just for easy math, let's say you buy a stock at $100 a share. Now, when you buy that stock at $100 a share, if that stock drops 20, 30, 40% in value, you've lost 20, 30, 40% of your investment if you just hold on to the stock. If you buy a long put option and use it almost exactly like an insurance policy works, you can protect that stock. And the way it works is that when the value of the stock goes down, the value of the long put option goes up. if you use a covered call to pay for the long put, you can, in some cases, create what is essentially, for a period of time, a risk-free trade. Here's what happens. Let's say we buy that stock, we buy this long put option that expires in a couple of months, and we sell a covered call that pays us for the price of that long put, and the stock goes down. Well, our long put will have gone up in value, and instead of having to sell that stock low or wait for it to come back up, we can be perfectly protected between these two options, both profiting, both of these profit as this one goes down. And it can be a perfect offset. And for a period of time, you can be close to zero risk. And in some cases, you can be absolutely zero risk for a period of time. Now, this is a fantastic way to trade if you just want peace of mind. And don't worry about, if you're new to options and you're new to the stock market, or you've never used options with stocks, we can teach you all of that. But I want to show you the real value of this trade. There's a thing called dollar cost averaging. I'm gonna back up my screen a little bit here and get rid of these two items, and we're just going to talk about the stock for a minute. There's a thing called dollar cost averaging. A lot of traders, a lot of investors do this. They buy a stock for $100 a share. That's just our hypothetical amount. And the stock has a little bit of a pullback. And you hear people on TV and you hear people on the internet, they always talk about buying the dip. They say, buy the dip. I'm going to add more shares when this stock pulls back a little bit. So they buy the dip and they add some shares right here. And that's great if the stock makes a move back to the upside, because they've got some shares at $100 a share and they've got some shares maybe down around $80 a share. And so their average price per share is around 90. And as long as the stock comes back up above 90, they're in great shape. Now, a more dramatic example is maybe the stock goes down and you buy some shares at 80 and it goes down a little bit farther, and you buy some more at 70 and it goes down a little bit farther and you buy some more at 60. You're only going to do this if you believe the stock is going to come back up. But when that stock eventually comes back up, you've brought the average price per share down every time you've added some more shares at a lower price. Now, this is a great strategy to use, but it has one fatal flaw. Actually, two. I gotta back up. It actually has two flaws to this strategy. Number one, what happens if the stock never recovers and gets back up to that price you bought at, or even the price you've averaged it down to? What if you've got some shares here and you've got some here and here and here and here and here? And by doing that, you've brought the average of all those shares down to 25% less than what you bought the original ones. So all these shares you have right now are at an average of $75 a share instead of $100 a share. What if that stock never makes it back up to 75? You've added a lot more money into that position and you're still losing money. You're still losing money overall. That's one of the fatal flaws. The other flaw is, where do you come up with all this extra money to add shares here and add shares here and add shares here and add shares here? And every time you do this, you got to come up with more money to do it. And so the flaws in dollar cost averaging is, if the stock never rebounds enough, you could have put a lot more money into that and still be losing money. The other flaw is, what if you run out of money to add to the position? And this is what a lot of people find themselves. This is why a lot of people find themselves in trouble. And the collar trade cures that. Because if you take the concept of the collar trade, which protects your stock, just like an insurance policy would protect your car or protect your house, and then you add that concept of dollar cost averaging into the equation, let me show you what happens. It's absolutely fantastic. I'm going to show you a real life example. A member of Safe Option Strategies that joined our program back around July of 2017 had bought into Snap. They're the parent company of Snapchat. He bought into Snap at their IPO and he ended up getting a few hundred shares for right around $24 a share. He was into this position for $7,200 back in March of 2017. And almost right after he got in, the stock took a pretty heavy dip. And around the time he came to us and looked at a presentation, just like the one you're watching right now, he said, I got to learn this. And the first thing I got to do is make sure I don't lose any more money on Snap. He was already down quite a bit from his original investment. So we taught him how to collar trade. And for the next 5 or 6 months, Snap was up a little bit and it was down a little bit and it was back and forth. He didn't make a whole lot of money during this time, but he didn't lose anything else. He protected his position and he maintained where he was at, and he actually profited a little bit through this period of time. Then he had a really nice big run to the upside on an earnings report, feeling really good because he got back most of what he had lost from that original buy-in that he had around $24 a share. But then when everything turned and crossed over technically, we made sure we helped him get a collar trade in place. And what happened as a result is that when this move down took place, he put into effect that dollar cost averaging. But here's the difference. Instead of having to come up with more money, this is the key part right here, no added investment. Instead of having to come up with more money, instead, he used the profit from those long puts and those short calls, because both of those profited when the stock moved down. He used the profit from those long puts and short calls, and he was able to add 100 shares to his original investment without adding any money. It was only the money he took in on the profit of those two options. So he protected himself on the way down, and then when he got some technical indicators suggesting that things were moving back up, he acted and he added more shares, and it cost him nothing. Stock went back up a little bit and got close to its next earnings report, and before its next earnings report, he put that same collar around. Now he's doing it around 400 shares instead of doing it just around 300 shares. Snap didn't do very well on its earnings report. For the next several months, they were down, 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 down. And when he got a signal, technically, did his homework, followed some good technical indicators, saw that the stock was moving back up, the profit he had from those long puts and those short calls allowed him to add another 500 shares and still no added investment. He put no additional money. His original investment at this point in time was still only $7,200. Now, Snap had a really nice run to the upside shortly following that, wobbled a little bit, and then had a second nice run to the upside. And there were some adjustments made in here. There were some times when he had to roll some long puts up, and there were some times when he had to roll some short calls. There's more to it than just being perfect on the timing of adding and taking away those long puts and short calls. We teach you how to do all of that. But when this stock got back up to $18 a share, he was 125% profitable. And keep this in mind, his original buy-in to the position was $24 per share. He was still trading at approximately a 25% loss on the stock value, but he was now up 125%. Now, he worked through some more adjustments as time went on, had another nice run up, and then guess what? Guess what this next drop is? Can you take a guess? If you're looking at that bottom of the screen, you know this next drop had everything to do with the pandemic that hit. Right at the end of February, everything started to tank. That happened to coincide pretty close with Snap's next earnings report. In fact, Snap reported its earnings at the end of January, started to fall down, started to recover a little bit, and then the pandemic hit and a huge sell-off. And at the bottom, and not right down here at the bottom, because we're not that good, we didn't know that this is the day that Snap would reach its lowest point and then it would bounce back. We waited until there were technical crossovers and jumped into some more shares. And at this point in time, he was able to add 400 more shares. And again, no added investment. This is what's so fantastic. It's the benefit of that dollar cost averaging, but you're not having to come up with more money somewhere in your portfolio. And right around middle of summer, middle of July of last year is when he shared all the details of his trade with me. And we were helping him. He was emailing us. He was calling us. He was saying, hey, you know, here's where I'm at. What do I do now? And we were teaching him and we were helping him do it. But it wasn't until the end of July that he showed me exactly what his results were of all this work that he had done. And folks, at the end of July of last year, he had 1,300 shares. He had now been in this position, this trade, for a little over 3 years, but he was up 376%. And at no point in time from his original investment had he ever added more money to this trade. Now, after he shared this with me, I started sharing this with people like you that are watching this presentation right now. And I loved sharing these results. It was so fantastic. I let a number of months go by, 7, 8 months, before I asked him, hey, where are you at with Snap now? Because on this screen, here's where we ended that other screen, right here at the early part of July of 2020. And at the move down right here, he had an opportunity to add a couple hundred more shares. And then look what Snap has done since then. Look at how crazy to the upside Snap has gone since then. Now, the other thing he did when he added 200 shares here, he made sure he had no short calls and no long puts in place. And he decided he was not going to add them again unless he actually got some technical crossovers to the bearish side. So he allowed this to go up with no options in place that might slow it down a little bit. And folks, as of a couple of days ago, when Snap finished right around $64.51 per share, his 1,500 shares were worth $96,000. 89,000 of that and some change is profit. 1,244% profit in 4 years. Now think about where you're at in your trading right now. Think about the size of your portfolio right now. I absolutely unequivocally cannot promise or guarantee that you could make 1,200% in the next 4 years in your portfolio. But I can tell you a lot of our students are doubling their portfolio annually, or they're doubling it every couple of years. And some of them are, in many of their positions, going up as high as 500, 600, 700% inside of a couple of years. And every once in a while, you hit a home run and you get a trade like this that is just absolutely phenomenal. But in the midst of all of this, you never lose sleep when the stock is dropping. I want to show you another example. And the thing that is so key about this example is a 17-year-old did what I'm about to show you. Back in October of 2019, a 17-year-old who had saved a couple of summers worth of summer jobs and lawn mowing and miscellaneous other stuff that he did during the summer, bought 200 shares of Ford Motors when Ford was trading around $8.50 a share, made a total of a $1,700 investment, October of 2019. Little bit of back and forth, little bit of learning the program, learning when to add the long puts, when to take off the long puts, when to cash them in. And right before Ford announced their earnings at the end of January, he made sure he had a collar trade in place on this trade. He had his long puts, he had the short calls paying for him, and Ford reported earnings and started a pretty good drop. And then, guess what? End of February, boom, pandemic, crushed it, knocked it way down. But when it started to come back up, and when it crossed over technically to the upside, right around $5 per share, he was able to add 200 more shares to his position because the long puts and the short calls that he had in place profited enough for him to do that on this big drop down right here. So with 200 shares and a nice move to the upside on Ford starting around the middle of May, had a little bit of a downturn, had a little bit of a time period where it wobbled and kind of flat and not going anywhere. And there were adjustments made during this time. There were different things he did. Then he had a really nice move up on Ford. And when Ford got back up to $9.25 a share, in barely over 1 year of being in this trade, he was up 118%. 118% in just over a year. Folks, a 17-year-old did this. In fact, I got to recant that. He was 16 right here, and he turned 17 right here. But most of the work was done right here. Okay? This little pullback Ford had right here, little pullback they had right here, gave him an opportunity to get rid of the long puts and the short calls, and he cashed in some profit on them. Didn't really have the extra money to add shares at that time. But a nice run up on Ford over the last several months has taken them up to $12.75. And that was a few days ago. At the time I'm recording this, Ford has had a day of some sell-off. But when Ford reached $12.75 a couple days ago, his 400 shares were up $3,400 or 200% growth, and he has not even been in the position for 18 months yet. Now, I want to point this out. If he would have just bought Ford right here and held on to it, he would have been crying when all of his money was, over half his money was gone right here. He would have got excited as it was coming back up and then maybe cried a little bit and got excited again and maybe been a little disappointed. And he'd be up 50% right now. And in 18 months or less to be up 50% on a company, that's not a horrible thing. The U.S. stock market indexes average around 12 to 13% annually over long periods of time. So to be up 50% in 18 months would not have been a bad deal unless you could have been up 200%. I know for a fact this trade worked because it's my son who recently turned 18 that did this trade. Folks, we teach a lot of stuff at Safe Option Strategies. Something you've got to decide going forward when it comes to making money in the stock market is figure out who you're going to listen to. Listen to someone who has your best interest in mind. This is a chart of 2008, and I believe we are sitting on the precipice of having a repeat or worse of what we got in 2008. And you can either learn how to do this and never stress during a downtrend like this, or you can stress out the next time the market drops 34% or 35% in a matter of a few weeks, or the markets like in 2008 sell off 50+% over the course of a little bit less than a year. You can go that route, or you can take a look at how we can teach you how to do a lot better than that. If you just want to learn how to collar trade in a way I just showed you, we've got a pretty phenomenal discount going on our collar trading program right now. We've got discounts going on the rest of the program. And if you want to receive even a larger discount than what I just showed you, email or give us a call or scroll down a little bit on the page that you're on. This is the page that you're on, and you're watching this presentation right here. Watch the other presentation. It's short. You probably already watched this one, I'm guessing. But scroll down just a little farther on this same page, and you'll see a little form like that. Fill out this form or send us an email to info@safeoptionstrategies.com or call us on this toll-free number. Let me know what's going on with your trading. I'll tell you about a deeper discount that we only offer to people who reach out to us. and we'll see if what we're doing is a good fit for you. And I hope it is. Have a great day. Bye-bye.